Chinese currency go from no exposure, while the US dollar has been relatively stable. China was way smaller than the United States. Brazil and China just made some deals fully exposed to the dollar. The potential for Bitcoin is huge, and you have very high inflation because of excessive bank lending. Ever since the global financial crisis, you've seen for decades, countries, for example, were decreasing their tonnage, their gold reserve tonnage, and increasing their dollar exposure in their central bank reserves. Starting in 2009, that trend reversed, where countries began reaccumulating gold. They went from under 30,000 tons to something like 36,000 tons. They had it's like a V-shaped change. They were going down and they started going up for, 15 years now, 14 years. They've also, around the margins, you've seen Chinese currency go from no exposure in reserves to a little bit of exposure in reserves. It's grown quickly from a very, very tiny base. You also seen the euro lose general holding, while the US dollar has been relatively stable. I think there's two sides to these headlines, and both extremes tend to, in my opinion, be wrong. So, there's a lot of headlines around threatening dollar reserve status. There's a lot of headlines around these alternative things. And there's been a long history of this. There's been decades of countries trying to make currency alliances, things like that. And so, a lot of people jump on the hype train, and I think that's in some ways overstated. On the other hand, I think it's a mistake for people that miss this and say, oh, it's been happening for decades. It's never going to happen. Don't worry about it, because obviously things have changed, right? This isn't 2004. This isn't 2012. Back then, China was way smaller than the United States. Now, in many measures, it's larger than the United States. So the biggest trading partner with the majority of countries now. We froze Russia's reserves. We've kind of pushed Russia and China closer together. Saudi Arabia's relationship with the United States has cooled, while their relationship east has improved. And so we've seen a number of headlines, which is basically Saudi's cozying up to China a little bit. Brazil and China just made some deals to kind of, exchange their currency more directly. China having a better prospect of being able to buy commodities and energy in its own currency. And so I think the general trend shift is that we're going towards a more multipolar world, which makes sense because, there was this 30-year period from the early 90s, like the fall of the Soviet Union, until, a handful of years ago, where we were in a very unipolar world. There's the United States and everything else built around it. And now, which is the more natural state of affairs, you have a handful of different regional powers. So China's economy is comparable to the United States now. It's higher in some ways, it's lower in other ways. You also have, the Eurozone is the big bloc. You have a couple other regional powers like India, Brazil, Russia, obviously. You have these kind of regional powers, and that's the world we currently live in. So unless something devastating happens to China or some of these countries, I think the trend is towards a multipolar world for both payment systems, so that countries are, protected against getting cut off from the dollar, as well as reserve diversification, so that they don't have 100% of their reserves or 60% of their reserves fully exposed to the dollar and either inflation risk or seizure risk. So I think it's on the horizon, but it's still early because Bitcoin's not big and liquid enough to scale yet. I mean, right now we're still at the stage where large individuals can move the price, let alone countries moving the price. And so I think it's one of those things like Bitcoin kind of needs another zero on its liquidity and its market cap in order to be relevant at that scale. Right now, it's really about gold, dollars, and yuan, kind of, and these alternate payment systems, and less so about Bitcoin. But obviously, the potential for Bitcoin is huge, and certainly you must have countries looking at it. Russia's mentioned it. The number of countries have clearly looked at it. I think there's a lot of truth to it. I think the people that are covering it are asking the right questions, right? So, for example, with, say, one of the banks, like Signature, for example, when that bank was closed and now their crypto network's up for sale now, and, the FDIC is supposed to get maximum recovery for deposit holders and for taxpayers now, and that they're not willing to sell that, it seems, right? I think there's interesting questions that should be asked to hold them to account. And fortunately, this goes back to the 1940s. If you look at the 70s, right, if you have very high inflation because of excessive bank lending, the central bank can tighten a lot and slow that down because debts are very low. You can just say, okay, everything's tighter now, a super high interest rates, and that will curtail lending. The problem is if you have a 1940s environment where the sovereign itself is very, very highly indebted, there's tons of debt in the system. They have trouble raising interest rates super high because in addition to causing all these bank problems, it also compounds into causing more and more fiscal deficits that have to be monetized. And so what they generally do in that environment is they're less likely to raise interest rates super high the way like Volcker did. And instead they keep interest rates low or moderate while then also doing capital controls or lending controls to prevent, lenders from taking advantage of those negative real rates. And you see that, for example, in Turkey today. They say, okay, if you're a corporation, you can't borrow lira and buy foreign currency with it, right? Because otherwise, why wouldn't you? Their interest rates are not high enough to compensate you for lira inflation. There's a good incentive to borrow lira and buy almost anything else. And so they try to restrict that type of speculative attack on their currency. You've also seen Nigeria, for example, they've cut off their banking system to crypto exchanges. And so I think around the margin, that is one of the defenses that these countries turn to. And I think in developed markets, we are early signs of that, basically that they're clamping down around the margins where they can and where they think they have cover to do so. I think from their perspective, yes. I mean, basically, if a country mismanages its ledger or has to do things that are not popular, that's where they turn to controls. And so in the United States, for example, during World War II, during the 30s, even before World War II, and continued until the 1970s, it was illegal for Americans to own gold. So 40 years couldn't own gold. And the reason for that essentially was the US ledger was being inflated and they had to try to ban alternative ledgers. They say, well, you can't use gold as your savings. You have to use the dollar and you have to sit there and earn negative real yields for like a decade. And if you don't want to, then tough luck. And funny because the United States, so mostly they only ban upwards, right? So for example, the United States was basically, but maybe Switzerland aside, but basically Swiss and the United States were like the two strongest currency systems you could be in during that period. So the only thing the United States had to worry about was gold. You didn't have to worry about people wanting to go into like French currency because they were getting wrecked even more. And so they only had to ban upwards. Similar today, Argentina will freak out and try to prevent people from getting into dollars too quickly. Whereas the United States is not worried about people going into Argentine pesos too quickly. Nigeria is worried about people going into dollars. They're worried about people going into Bitcoin and stable coins and things like that. So yeah, basically it's these ledgers turn to protective measures when their own system is weak and they want to try to prevent flight into something stronger. So the market is currently pricing that it thinks that they're basically done, that they're going to pause. I would not be surprised to see another 25 basis point hike around the margins, because at this point, I now have to get into the head of Jerome Powell, and I don't know personally. It's basically asking about one person's decision, which that's how our system's built. So I think that they're certainly on the path where they're slowing down and approaching a pause, because there's only so quickly you can raise rates without breaking everything. And I think that's the issue. And I think also later this year, so right now, the Treasury has been providing liquidity to the market, ironically because of the debt ceiling. They can't issue new debt. And so one of their extraordinary measures is they start drawing down their existing cash balances, which is actually pro-liquidity for the rest of the market. Basically, there's this void of capital that the Treasury holds that is now entering back into the market out of necessity. And that will, they're almost out. So roughly by the summer or late summer, depends on tax revenues and expenditures, things like that. Their current estimate is like summer, early autumn, they'd run out. Whenever the debt ceiling is resolved, one way or another, when they go to refill their cash balance, that is extremely negative for liquidity. And I think the Fed's gonna have trouble being tight while that happens. So I do think there are a lot of interesting factors that start hitting in the second half of this year. But I think that in the next couple months, there's really nothing outright preventing the Fed from continuing to either hold or inch a little bit tighter.